In this video, we will discuss savings for retirement as a time value of money example. Consider the following problem if you are currently 30 years old and would like to retire at age 67. You currently have no debt or savings. If you start making monthly deposits tomorrow in an index fund of the Wilshire 5000, which is the broadest stock market index in the United States, and assume it will return 10% compounded monthly, how much must you save to retire with $1 million? This problem can easily be solved on a financial calculator or using Excel. In Excel, we would say the number of payments is going to be 444, coming from 37. 67 minus 30 are 37 years of savings with one payment every 12 months. The interest rate will be 10% compounded annually divided by 12, or 0.008333. Initially, you have no money in the bank. You want $1 million, and we want to figure out what the payment on a monthly basis should be. Since it says starting tomorrow, we will be in begin mode, and you would use the Excel calculation for payment, where the components of payment are the first one being B8, the interest rate, the second one B7, the number of payments, the third one B9, the amount of money you owe or have in the bank, the fourth one B11, the future value of money you want to have, and then the 1 indicates begin mode. And we show that under these conditions it is quite easy to retire a millionaire by only saving $212 per month. If we change the 1 to a 0, that means we start the payments just 1 month later at the end of the month, and this goes from $212 to $214. We can also look at other variations. This already shows if you wait a little longer, you have to save more money. What if you wait till you're 50 to start saving? Then we would change the N to 67 minus 50, or 27 times 12. Now we only get 324 payments, and the amount of money we have to save for retirement goes up substantially to $602 in begin mode, or $607 in end mode, showing again the sooner you start to save for retirement, the easier it is to retire wealthy. We can also make other variations to this calculation. What if you are in debt $20,000? The default for being in debt is actually a positive. The way the calculator or Excel works, a deposit in the bank away from you is a negative, a withdrawal to you is a positive, so being in debt means you put in a PV of a positive 20,000. In the next example, we will use a negative 20,000, which means you have 20,000 already in the bank. If you're in debt 20,000, then this number is going to go up even more. So in our first example, you had to invest $212 every month. Now we are going back to the example of you starting at age 30, still having 444 payments, but instead of depositing $212 in the bank, you now have to make $387 every month in deposit if you are in begin mode, and $385 in the bank if you are in end mode. In our last example, we will again look at you starting at age 30, but now you are in the advantageous position of already having $20,000 in the bank. We do the exact same calculation, but PV changes to a minus 20,000 for having already deposited 20,000 in the bank, and now you have to save almost no money, $43, to retire a millionaire. A very nice position to be in. So the indication of all of this is start as early as you can, assuming a good rate of return of the Wilshire 5000, and this is a typical long-term stock market rate of return. One disadvantage we are in today is the stock market is historically highly valued on a P/E ratio basis. This is the Wilshire P/E, which shows the P/E using the average earnings over the last 10 years. We are near the peak of that. We aren't nearly as high as during the dot-com bubble, but we are as high as the stock market was before the stock market crash in 1929. So this number may be higher than realistic, and stock market returns may not be nearly as good as they have been historically. These examples have been using Excel. You can also do the same calculations using a financial calculator. The one I would recommend down here is the Texas Instruments BA2+. If you are going to be taking the CFA, Chartered Financial Analyst, or the CFP, Certified Financial Planner exams, you would need to become familiar with this type of calculator. I thank you for watching this video.